In this video, I'm going to analyze companies which are into manufacturing of chemicals and chemical related products. The companies that we are going to analyze in this video are Tata Chemicals, Godrej Industries, Pidilite Industries, Aarti Industries and Castrol India. Tata Chemicals is our main company which we are going to analyze, and we'll compare it with the other peer group companies. Tata Chemicals' current market price as on 28th June 2019 is 641 rupees, and it is down from its 52 weeks high by 17%. The most fall was seen in Godrej Industries at 25% from its 52 weeks high, and the least fall was seen in Pidilite and Aarti Industries. So here, the lower the fall, the better it is. The more strength is shown in the company when the price don't fall much from their 52 weeks high. And more the fall, the weaker the stock is. But it also creates an opportunity for the investors to buy at a discount from its 52 weeks high. Tata Chemicals earning per share during the last 4 quarters. We have the 2019 March data with us. The earning per share was 45 rupees, and the earnings yield, which measures the profit earned on each share, is 7%. That is, on a price of 641 rupees per share, the company's earnings were 45 rupees. That translates to 7%. And the earnings yield is the highest in the peer group company. The lowest earnings yield was Pidilite at 1.4%. That is, on a price of 1223 rupees, the company earned just 18 rupees per share, which translates to 1.4% of earnings yield. Next, we'll look at the price earnings multiple. This is the current market price, and we compare that with the trailing 12 months earnings per share. This ratio guides us in understanding how far away the price is compared to the earnings. Investors were paying 14 times the earnings of the company. That is, the earnings per share was 45 rupees, and people were paying, or investors were paying 641 rupees for that share. So that is 14 times more than the earnings. Here we want the PE ratio to be as low as possible so that we don't overpay for the company's shares when compared to its earnings. Godrej Industries' earnings and price comparison gave us a multiple of 28 times. That is, earnings was 17 rupees and the price was 490 rupees. That is a multiple of 28 times between the two of them. So we don't want the price earning multiple above 25 times. Our benchmark should be at least 25 or below that. Pidilite's price was trading 67 times higher than its earnings. This is a very high value, and we have to be careful that we don't invest in companies whose price earning multiples are trading at a very high premium. Here, the earnings per share was 18 rupees, whereas the price was 1200 rupees. That's a multiple of 67 times. Aarti Industry too was trading about 25 times. Its earnings were 57, whereas the price was 1782 rupees. Castrol India's price earning multiple was 18 times. As I mentioned earlier, we should look for 25 or below that. Let us look at the last year's price earning multiple. The previous one was the current price compared with the latest earnings of the company per share. And this ratio measures the current price against the last year's earnings. Since the last year's earnings was itself the current month, we have the same ratio. So wherever we see the same ratios between price earning of 12 months and price earnings of the last year, it means the company's data is up to date till March 2019. Let us look at Godrej Industries price earning of last year. Last year it was trading at 39 times higher than its earnings. Pidilite again was trading at a very high PE multiple of 64 times. Aarti Industries too was trading at a very high multiple of 45 times. And Castrol was near to what it earned last year at 18.9 times. Let us look at the historical average price to earnings ratio during the last 5 years and during the last 3 years. This ratio helps us in understanding how the price earning multiple was over a period of last 5 years and over a period of last 3 years. This helps us in comparing the current price earning with the historical price earning and see where it is trading at premium or at discount to its averages. Tata Chemicals 5 years PE and 3 years PE were at reasonable 13 and 11 times, and the current price earning multiple has gone slightly above that. Godrej Industries for both 5 and 3 years was at a historical high of 45 and 53 times. Even last year it was quite high at 39 times. So Godrej Industries has been trading at a very high premium multiple to its earnings. Pidilite too has a similar case where its historical price earnings were very high at 53 and 47 times, and in recent years it has gone up even higher at 64 and 67 times. Aarti Industries 3 years and 5 years historically was trading at a very good multiple of below 25 times, but in recent 12 months and even last year the price earning multiple has shot up to 30 and 45 times. So it has become very expensive in the recent last 2 years. And we can see because of the price going up, because the price has fallen very low or very less compared to its 52 weeks high. So we see here that the price has gone up, but the earnings has not gone up in that same pace, because of which the price earning multiple has shot up. Castrol India's historically had been trading at a high PE valuations of 35 and 30 times, and in recent 2 years it has come down to a good valuation of 18.9 times. So we are getting Castrol India at a discount to its averages. To recap, Godrej Industries had the highest fall from its 52 weeks high by 25%, and Aarti Industries had the least fall at 6.15%. In terms of earnings yield, Tata Chemicals managed to earn the highest yield of 7%, and Pidilite had the lowest yield of 1.4%. In terms of recent price earning multiple, Tata Chemicals has done the best and is available at the lowest price earning multiple of 14 times. Pidilite is the most expensive and its price is 67 times higher than its earnings. In terms of 5 years historical price earning, again Tata Chemicals has been trading at a very economical price earning multiple of 13 times on average. Again, Pidilite was the most expensive at 47 times its earnings. Next, we'll move on to price to OCF comparison, price to free cash flow comparison, then price to book value comparison, and finally price to sales comparison. All these metrics along with price earning helps us understand where is the price compared to different variables. Price to operating cash flow ratio helps us understand where the price is compared to the company's cash earnings. The cash earnings is calculated by considering the cash inflows and outflows from the operating activity of the business. Tata Chemicals price was 10 times higher than its earnings, cash earnings. Godrej Industries was trading 9 times higher than its cash earnings. Pidilite was very expensive at 78 times its cash flow. Aarti Industries too was very expensive at 49 times its cash flow. And Castrol India was at 24 times its cash flow. Now, what we want to understand out of this ratio is that we want the price to be not more than 25 times of its cash earnings, just like price earning multiple. The cash earnings basically helps us in understanding how much of the profit has actually got converted into cash in the books of the company. The earnings portion can be manipulated by the management, but the cash flow or operating cash is very difficult to manipulate. So, if we have to really understand a price to cash, we have to understand the cash flow statement. And if we have to rely between price earning to price cash, I would say we should look at price cash more than the price to earnings ratio. Let us look at the price to free cash flow ratio. This ratio basically tells us where the price is compared to the free cash flow of the company. What is the free cash flow? Free cash flow is the cash flow from operations, and we deduct from that any investments done in buying of fixed assets. So whatever remains is the free cash flow which can be used in the investing activity of the business. Here too, we don't want it to be more than 25 times. That is, price should not be more than 25 times its free cash flow. Tata Chemicals free cash price is 32 times higher than its free cash flow. Godrej Industries is very economical at 13 times, which signifies that the company has a good amount of free cash flow with them. Pidilite is very expensive at 100 times its free cash flow, which signifies that the company has very low free cash flow left. Aarti Industries had a negative free cash flow. This signifies that the company has spent more in the buying of fixed assets than what it earned through cash from operations. Castrol India's price to free cash flow was 28 times, slightly above 25 times. That is our benchmark. Next, let us look at the price to book value. This ratio helps us understand where the price is compared to the book value of the company. Now, what is a book value? Book value is the net worth of each share. That is, what is the actual value of the share as per the company's books or as per the company's records, and that price we compare it with the market price of the share and see whether it is trading at a premium or discount to the book value. Tata Chemicals is very near to what the shares are actually worth, or it is trading very near to its book value. Godrej Industries is trading 3.7 times more than its book value. Here we want the ratio to be less than 2.5 times. Pidilite is trading at an extreme valuations of 14 times its book value. Even Castrol India is very high at 12 times its book value. Aarti Industries too is very high at 5.75 times its book value. So if you have to buy into any of these scripts and looking at the numbers, only Tata Chemicals seems justified for investment because it has a very good price earning multiple, a very good price to book ratio. These are just the valuation metrics which helps us time our entry into the script. They don't tell us anything more of the company. For that, we'll have to look at other ratios like sales growth, profit growth, how much of the profit of the 5 years has got converted into cash, how much free cash flow the company has, what is the promoters holding, have the promoters pledged any shares, how much debtors were there on the books of the companies against this year's sales, and many more ratios that we are going to look at in this video. Most of these companies were trading at a high price to book valuations. Next, let us see the current market price to sales ratio. This particular ratio helps us understand where the price of each share is compared to the sales that was contributed by each share, or we can say what was the total market value of the company and how much sales it did compared to the market cap of the company. So this ratio will tell us whether the company's sales are good enough and high enough to be near its market cap. Tata Chemicals market cap or total market value of all the shares was 1.4 times higher than the sales that it did last year. Godrej Industries total market value was 1.4 times higher than its sales. Pidilite's price was way too high. In fact, it was 8 times higher than what it sold last year. Aarti Industries too was 3 times higher than its sales. And the price of Castrol India was 3.4 times higher than the sales that the company had done in the last year. We don't want the price to be very high when compared with the total sales that the company has done. We also have to understand if the price to book value is high, what is the reason that the market participants or investors are willing to buy the shares at such high valuations? Is it because the company has a very high profit growth rates or very high sales growth rates? Or what is the exact reason for giving Pidilite such high book value multiple, sales multiple, even the price earning multiples? To recap, Godrej Industries had a very good price to cash ratio as well as free cash flow ratio. Pidilite had the highest or most expensive price to OCF comparison as well as free cash flow comparison. Even in terms of book value and sales, it was very high. So the Pidilite Industries was trading at a very high price, earnings price, cash price free cash flow, price to book value, and price to sales ratio. In terms of price to book, Tata Chemicals along with price to sales was the best. Next, let us look at the growth rates in profit of these companies over a period of 5 years and over a period of 3 years. We don't have the value for Tata Chemicals for the 5-year growth rate because 5 years back the company had suffered losses, because of which the growth rate cannot be calculated. Godrej Industries' profits have been falling at the rate of 2.34% since 5 years back. Pidilite has been growing its profit at the rate of 18% compounded over a period of 5 years. Aarti Industries' profit has also grown at 19%. Castrol India has managed a 7.5% growth rate. Looking at the last 3 years' growth rate, Tata Chemicals' growth was 7.9% over a period of 3 years. Godrej Industries has done a growth rate of 4%, better than where it was in terms of 5 years back. Pidilite's growth is very good at 23% over a period of last 3 years. In fact, it has increased further from the 5 years. Aarti Industries' profits have also grown at 19%, and Castrol India's last 3 years profit growth has declined to 4.5%. Here we want to see at least a 10% growth rate in profits year on year for all of these companies. Aarti Industries and Pidilite both saw a high growth in their profits over a period of 5 years and over a period of 3 years. Tata Chemicals had a loss 5 years back, because of which it didn't have any value, and Godrej Industries had the lowest growth in its profit over a period of 3 years. Next, let us check the price earnings to profit growth rates. This ratio, PEG ratio of last 5 years, considers the latest price to earnings ratio and divides that by the last 5 years growth in profit. Since we don't have the profit growth rate for Tata Chemicals, we won't get a 5 years PEG ratio. Godrej Industries had a negative PEG, which means there was a degrowth in profit of the company over a period of 5 years. What this ratio tells us is that the price earning multiple that was paid for the scrip, that is 28 times, against the earnings, how fast is the earnings growing. In this case, for Godrej Industries, we saw that in the last 5 years the profit has been falling instead of growing. So therefore, we get a negative PEG of 11. Here we want the ratio to be between 0 and 1.5, which signifies that we will be able to recover our invested money into the business much faster than waiting for many years. Pidilite's PEG is 3.5 times, which means that although we are paying 67 times the earnings, that earnings is growing at the rate of 18% over a period of 5 years. So we can expect our capital to be recovered much faster. Although the PEG is above 1.5 times, this ratio is still better than for Godrej Industries. Aarti Industries PEG is very nearby to 1.5 times, which means for the price earning multiple that the investors paid 30 times, we are getting a growth rate of 19% over a period of 5 years, which again signifies that the investors will be able to recover their price earning multiple that they paid much faster. Castrol India's price earning multiple is again high at 2.5 times. So we want these ratios to be at least below 1.5. None of the companies have managed to bring their PEG below 1.5 times. Let us look at the PEG of last 3 years. Only Aarti Industries has managed to come very near to 1.5 times. Most of the companies are at a very high PEG values. Tata Chemicals has a good PEG of 3 years at 1.7 times. This ratio compares the current price earning multiple with the profit growth rate of the last 3 years. Here too, the most expensive was Godrej Industries, where the profits were growing just at 4 times, whereas the price earning multiple we are paying was 17 times. So even the 17 times price earning multiple is very high when 28 times price earning multiple. This too is very high. Other than that also it is about 25 times, so it is anyways high. But the PEG signifies that for that price earning multiple that we are paying 28 times, we are not getting the growth rate in earnings. The growth rate is just 4%, which means it will take us a lot of time or a lot of years just to recover the initial capital. So the lower the PEG, the better it is, and it signifies that our initial investment will be recovered much faster. This ratio is very important for investors to look at. Next, let us look at how the sales are growing for the company over a period of 5 years and how it's growing over a period of last 3 years. Tata Chemicals sales have been falling at a compounded rate of 6.5% over a period of 5 years. In fact, in the last 3 years, the fall in sales has accentuated to 8.7%. Here we want the sales to grow at least 10% year on year. Godrej Industries has not managed a very high growth rate in sales over a period of 5 years. In fact, in the last 3 years, the sales growth has fallen down further to 0.93% every year. Pidilite had a good sales growth rate over a period of 5 years at the rate of 10%, whereas in the last 3 years the sales has dropped to 7.8%. Same is the case with Aarti Industries, where in 5 years it was 12%, and the recent 3 years the sales has fallen further to 9%. Castrol India's sales growth was 4% and 5% over both 5 and 3 years period. Here we want the sales to grow as high as possible and possibly above 10%. To recap both the PEG as well as sales growth, we see that Aarti Industries has done very good, and Godrej Industries PEG was the highest. So whatever price earning multiple investors were paying, that was very high compared to the growth in profit for the company over a period of 3 years. Tata Chemical sales have had a fall in their sales over a period of both 5 and 3 years. Next, let us look at the return ratios, that is ROE, ROCE, ROA and ROIC, as well as asset turnover. All these ratios we'll look at one go. Return on equity calculates what profit the company earned on the shareholders' money or shareholders' contribution to the company. This is the last 5 years average ROE values. We want the return on equity or the profit earned on shareholders' money to be at least at the rate of 15%. Tata Chemicals on an average was earning 14%, very nearby to 15%. Godrej Industries has managed very poorly at just 6.8% over a period of 5 years. In fact, it's the lowest in the group. Pidilite has managed a return on equity of 27%. Aarti Industries has managed a 23% return on equity. Castrol India's return on equity is very high at 78%. The reason being the equity capital of the company is very low. That is why the profits earned inflates to a very high percentage. Let us look at the recent year's ROE. Tata Chemicals' recent ROE of the latest year was 8.3% and below the average of the last 5 years. Godrej Industries' ROE is almost same as the average. Pidilite is also very nearby to its average, earning a return of 27% on shareholders' money. Aarti Industries too is slightly below the average at 22%, and Castrol India in the recent year has earned an ROE of 64%, slightly below the 5 years average and the highest in the group. Next, let us check how the ROE has been growing from a period of 5 years. Since 5 years back, the company had losses. We don't have the profit growth rate for Tata Chemicals. Godrej Industries' return on equity has been falling over a period of 5 years at the rate of 7.32%. Here we want to see a growth rate as high as possible. Pidilite's ROE has been falling at a marginal rate of 0.04%. ROE for Aarti Industries has been growing at 0.26%. This is what as investors we want to see, but this too is very low. We want it to grow at least 2% and above. Castrol India's ROE has been falling at the rate of 1.66% over a period of 5 years. Next, let us look at the return on capital employed. This ratio measures what was the profit that the company earned on the capital that was employed into the business. Now, the profit that we are concerned here is not the net profit, but the EBIT, EBIT, which is the operating profit, and we divide that by the capital employed. In this case, we are considering the fixed assets of the company, that is the gross block or the total assets of the company deployed into the business, plus any current assets of the company. So we are taking the fixed assets as well as the current assets of the company, and we are reducing the current liabilities from that. So that gives us our capital employed in ROCE. So on an average, last 5 years, Tata Chemicals' return on capital employed was 12%. We want the ratio to be at least 15% and above, just like ROE. Godrej Industries' ROE is at 7.3%. Pidilite has a very good ROE return of 38%. Aarti Industries has managed an 18% growth rate in terms of capital employed into the business. And Castrol India had an abnormal or above normal growth rate in its capital employed. In fact, it is earning more profit than the capital that was employed into the business. The reason here being that the capital which was employed into the business was less than the profit that the company earned. In the recent year, Tata Chemicals' ROCE has fallen below the average. Godrej Industries' ROCE has slightly improved from 7% to 9%, but it is still below 15%. Pidilite's return on capital employed is very high at 37%. very nearby to its average of 5 years. Same is the case for Aarti Industries as well as Castrol India. So now we understand why Pidilite has been getting such high valuations in its price earnings, price cash, price book, because the company's return on its capital employed and return on its equity is very high. That is why investors give it a very high valuations. Next, let us look at the return on assets. Here we have to understand what is an asset and what is the return that we are talking about, what is the profit value. So here we are looking at the net profit value, and in terms of assets, here we have the total assets employed in the business less current liabilities. This total assets that we are talking about is the balance sheet size of the company, and we reduce the current liabilities from that. Tata Chemicals ROA is 5.7%. Here we want the return on assets to be at least above 10%. Godrej Industries return on assets was poor at 2.16%. Pidilite has managed a very high return on its assets. Aarti Industries has also managed a good return on its assets of 9.56%. And Castrol India had again a very high ROA of 80%. Now the difference between capital employed and return on assets is that return on capital employed considers fixed assets, whereas return on assets considers all assets of the company and reducing current liabilities from it. Let us look at asset turnover. This particular ratio calculates the sales multiple that has taken place against the assets of the company. Here, assets means the total net worth of the company plus the borrowings of the company. And we want to understand that whatever company has employed into the business in terms of borrowing money from outside source as well as borrowing money from shareholders, what is the sales against that, or how many times higher was the sales against that assets, or in other words, how many times over was the assets converted into sales. Tata Chemicals sales were less than its assets. Its sales were just 61% of its assets deployed into the business. Godrej Industries sales were 87% of the assets invested into the business. Here we want to see a value which is above 1 and as high as possible. Pidilite had a sales of 1.6 times higher than its assets. Aarti Industries too has managed to keep its sales above its assets. Castrol India had a very high sales multiple when compared to its assets. Its sales were 3.3 times higher than the assets deployed into the business. Let us look at the ROIC, or return on invested capital. Here we are looking at the operating profit as the written value, and the invested capital is the net block or the net fixed assets of the company plus the working capital. The difference between ROIC and ROCE is that ROCE considers all the fixed assets of the company, whereas ROIC considers only the net assets of the company, that is assets less depreciation. So when we look at ROIC, it helps us understand that those companies which are highly capital intensive, or those companies who are investing heavily in their assets, for those companies we need to look at ROIC value, and companies which don't have much investments in fixed assets, we can look at ROCE value. ROIC for Tata Chemicals was 13%, whereas ROCE was 10%. Here we don't consider the depreciation value. In fact, here we consider the depreciation value in ROIC. We reduce the depreciation from the fixed assets, whereas in ROCE we do not deduct the depreciation. Godrej Industries ROIC was 5.5%, whereas ROCE was 9.3%. Pidilite ROIC was very high at 57%. Same was the case with Aarti Industries as well as Castrol India, earning very high return on invested capitals. To recap, the ROE growth rate on average of 5 years was best seen for Castrol India. In fact, Castrol India has earned the best score in terms of returning on equity holders' money or capital employed as well as assets, asset turnover and ROIC. All values were exceptionally high. ROE growth rate over a period of 5 years was seen best for Aarti Industries. Godrej Industries has done the worst for all the ratios in terms of returning on equity, return on capital employed, return on assets. Even return on invested capital was the lowest. Let us look at the next few ratios. Let us check the profit that the company has earned over a period of 5 years, and then we'll compare it with the cash from operations and see how much of the profit has got converted into cash. This we'll understand through the ratio CFO to PAT. Next, we'll look at how much of the cash from operations was used up in the investing activity of buying fixed assets and how much was left as free cash flow in the last 5 years. This comparison will look through FCF to CFO comparison. The CFO to PAT comparison measures how much of the profit of the company has got converted into cash. So 86% above the earnings was converted into cash. That is, the profit was 5,600 CR and the cash coming into the business was 10,500 CR, which is 86% above the earnings. This is what we are looking for. We are looking for more cash coming in through operations than through earnings. Godrej Industries had 5% less cash than the earnings, which means out of 1070, 1014 came in as cash, which is a mild drop of 5.2%. But here too, we would like to see a positive value and above the earnings of the company. This ratio basically tells us how or whatever profit the company has shown in its P&L account, has that got translated into actual cash inflows for the business. Pidilite had 3.62% short in terms of cash earnings. The company's profit was 3,500 and the cash coming in through operations was 3,400 CR, which is around 3.62% short in last 5 years. Aarti Industries had 59% above its earnings coming in through cash. Earnings were 1,200 and cash coming in was 1,900 CR. Castrol India had 1.2% short from its earnings. Out of 3147 CR, only 3109 came in as cash, which is a mild drop from its earnings. So most of these companies have done well in keeping their cash earnings equal to the profit after tax figure. Next, we'll look at how much of the cash from operations was used up in the investing activity, that is buying of fixed assets, and how much of that was left over as free cash. We don't want companies to invest more than 50% of whatever they are earning in cash in buying of fixed assets. Companies start investing very heavily in assets or buying of fixed assets. That means it is very capital intensive, and if that assets do not are not converted into profit, then that could basically backfire for the business. So we want a good amount of free cash flow left out from the cash earned through operations, so that it can be used for financing activity like acquisition, or maybe giving out dividends or buyback or bonus, whatsoever the company wants to do with that free cash flow. Tata Chemicals had used up 34% in buying fixed assets out of 10,000 CR that they earned through operating activities, and out of that they used 34% in buying of fixed assets. Rest all they had as free cash flow of 6,883 CR. So as investors, we don't want this value to go above 50%. That is, spending on buying of fixed assets should not be more than 50% of the cash that the company earns. Let us look at Godrej Industries free cash flow. It had a negative 196%, meaning it earned cash of 1000 CR, but it used more than that. In fact, it used excess of 975 CR. That is, the company has spent or invested more than what it has earned through operating activities. This is where we have to be very careful that companies don't over invest into their business, and when this thing happens, it means the company is not growing at a steady pace. This could backfire for the company. It also increases, when the cash is 1000 CR, how is the company investing more than 1000 CR into their business? That is, now they have a negative free cash flow. That is, they don't have a cash of 975 CR with them, which means they have to borrow that money to fund the business operations. So free cash flow was 196% less than what it earned through cash. Pidilite's investment in buying of fixed assets was just 30% of its cash flow from operations. That is, it earned 3,400 of cash, and it still had 2,380 CR left as free cash flow. So the balance amount was invested in buying of fixed assets. Aarti Industries also had a very similar situation to Godrej Industries, where they earned 1,921 CR, and entire amount was used up in buying of fixed assets. Over and above that, they invested 120 additional CR into buying of fixed assets. That is 106% more than cash flow from operations. Castrol India had the minimal investment in their fixed assets, and they just spent 7% of their cash from operations into buying of fixed assets. So in terms of converting profit into cash, Tata Chemical has done the best by earning 86% more than its earnings, whereas Godrej Industries fell short by 5.21% below its earnings. In terms of free cash flow that was left with the company, we see that Castrol India has managed to keep maximum of its cash that it earned through operations as free cash flow, and it invested minimal into the business. Whereas Godrej Industries spent the most of its free cash flow, and over and above that, it invested 975 CR more into buying of fixed assets, which worked out to 196% more than their cash from operations. Next, we'll look at the average profit of the company of the last 5 years. On average, how much profit the company was earning every year, and we will compare that with the latest earnings and check if the latest earning is below the average or above the average. So if the latest earning value is above the average, it shows strength or growth in the profit of the company. And if it's below the average, it shows a fall in the profit of the company from its average. Next, what we'll do is we'll compare year on year profit growth rate. That is from the recent 12 months, how the profit has grown compared to the previous year. Finally, we will compare how much of the profit of the last year has got converted into cash. Previously, we looked at the 5 years data. In this ratios, we'll look at 1 year data. So when we compare the average PAT of the company against the latest PAT, we see Tata Chemicals latest profit has fallen 14% below its average PAT. Its average profit was 1134 CR in the last 5 years, and its current year's profit of the 12 months was just 973 CR, which is 14% below the average. Godrej Industries profit increased by 142% above its average. Its average was 214 CR, whereas the latest profit value was 518 CR, that is 142% above the average. Pidilite 2 earned 31% above the average. Aarti Industries profit increased by 95% above its 5 years average, and Castrol India's profit increased by 13% above the average. So most of these companies have grown their profits above the average except Tata Chemicals, whose profit fell below the average. Let us look at the profit growth year on year. Since Tata Chemicals last year profit and this year profit is one and the same value, we will ignore this for time being. Godrej Industries profits from its previous year has grown by 109%, almost doubled. So its profit in 2019 was 518 CR, and a year earlier it was 247 CR. So that is almost the double of this. Pidilite's profit from its previous year fell by a marginal rate of 2.18%. Aarti Industries profit grew by 48% year on year. From 316 CR, it increased to 469 CR. Castrol India's profit remained almost the same where it was in the previous year. Next, we'll look at how much of the last year's profit has got converted into cash. Tata Chemicals cash was 62% higher than its earnings. Godrej Industry seems to have earned a very high cash against its earnings or profit of 247 CR. It got a cash earning of 1690 CR. Pidilite's cash fell short by 16%. Aarti Industries' cash was very near to its earnings but fell short by 1.39%. Castrol India's cash came in short by 22%. The cash or the profit was 708 CR, whereas cash earned was only 549 CR. So we want this value to be greater than 0 or almost equal to the earnings of the company. That is, the cash from operations should be as near to the profit as possible. So to recap, we see that Godrej Industries has done the best in all the three ratios of 1 year. When we compare the PAT with the average, it has increased by 142%. When we compare the profit with its previous year's profit, we see an 109% growth. And in terms of conversion of PAT to CFO, we see a 583% jump in the conversion. Tata Chemicals current year's profit has fallen 14% below its average and had a fall in its profit by 59%. Here we have to understand the profit that we are considering for 2019 and 2018 excludes the extraordinary gains, that is, or losses that the company has incurred. So keeping that in mind, we see a 59% YOY drop in growth rates of the profit. In terms of conversion of profit into cash, Godrej Industries has done the best, whereas Castrol India's cash fell short of the earnings by 22%. Next, let us look at the quarterly analysis of sales and profit. Companies' quarterly sales growth rate year on year for Tata Chemicals was 8%. We want the sales of the companies to grow at least 10% year on year. Godrej Industries profit sales has grown by 48% over its previous quarter. This is the comparison of March 2018 with March 2019 quarter. Pidilite's sales have grown by 10%, Aarti Industries by 17%, and Castrol India managed to grow by 5.3%. Most of the companies have grown their sales over the previous quarter. Let us look at the quarter on quarter, that is from December 2018 to March 2019. This is a near quarter the comparison that we are doing. Tata Chemicals latest quarter had a fall in its sales by 2.56%. Pidilite too had a fall in their sales by 11%. Aarti Industries sales fell by 4.4% and Castrol India by 5.5%. Only Godrej Industries had a gain or a increase growth in their sales from its previous quarter. Let us look at the profit comparison or how the profit has grown year on year. Tata Chemicals, although sales increased YOY, its profit dropped by 71% over its previous quarter. We want the growth rate in profit to be at least 10% and above. Godrej Industries, both quarterly sales as well as quarterly profits have increased at a very high double digit. Pidilite's sales increased by 10% but profit increased by just 0.13%. Aarti Industries profit and sales have increased by double digits. And Castrol India's profit over a year ago period has increased by 1.76% against the growth in sales of 5.3%. So we want the sales to grow as well as the profit to also grow year on year as well as quarter on quarter. Let us look at the quarterly profit growth rate. The quarterly profit has grown 86%, that is from one quarter to another quarter, whereas sales had dropped by 2%, the profits increased by 86%. Godrej Industries profit also increased by 284%, whereas the sales increased by just 18%. All of these companies have seen growth rates except Aarti Industries profit fell by 6% and Castrol India's profit fell by 12%. Both their sales and profit in the near quarter have fallen by 5%, 4%, and 6% and 12%. So, in all ratios for the quarterly analysis, Godrej Industries have grown their profits and sales at a double-digit growth rates. Pidilite's quarterly fall in sales was at 11% and the highest in the group. Whereas, if we look at the quarter-on-quarter profit drop, we see Castrol India, whose profit fell by 12% from its previous quarter. Next, let us look at the net worth of the company and compare that with its contingent liability. This comparison helps us understand how much of the contingent liability was occupied of the total net worth. That is, those liabilities which may or may not arise in the future and for which the companies have not done any provisions or even shown in their balance sheet or P&L account, and these may arise anytime in the future. So we don't want a very high liability or a contingent liability against the net worth of the company. We want the contingent liability to not exceed 20% of the net worth. Net worth is the actual value of the company after the company clears off all its liabilities. Net worth is calculated when the company clears off all its liabilities by selling all its assets. And after clearing all its liabilities, whatever remains with the company is the net worth of the company. Most of these companies have kept their contingent liability below 20% of its net worth, except Godrej Industries, whose contingent liability is 862 crore against the net worth of 4346 crore, which is almost 20%. Otherwise, most of these companies' liabilities are very minimal. Let us look at the debt equity and interest coverage ratio and debt to profit. The debt to equity compares how much the company received through borrowings and how much was the contribution of the shareholders. Here, this comparison helps us understand if the debt is high against what the contribution from the shareholders was, and if it is very high, then the company will have to pay more interest cost on those borrowings, which ultimately will create a situation where the shareholders will receive less profits. So we don't want the debt equity ratio to be more than 1 times. Companies can increase their borrowings above 1 times also, but provided they do that at a low borrowing cost. That is, their interest cost on the borrowings should be as low as possible, and it should not affect the profit in a big way. Tata Chemicals and all other companies had very low debt to equity ratio except Godrej Industries, whose debt was 1.59 times more than its equity, because of which its coverage also has fallen below 4 times, which is just 2.93 years. Castrol India didn't have any debt, and Pidilite had a very low debt to equity ratio of 0.03, almost next to nothing. So we want the debt to equity ratio to be below 1 for all of these companies. Next, we'll look at the interest coverage. This ratio is calculated by calculating the EBIT or the operating profit and dividing it by the interest expenses that the company paid in the latest year. So here this ratio helps us understand how well or for how many more years can the company sustain paying the interest cost using this year's EBIT or operating profit, meaning this year's operating profit can cover how many more years of future interest payments. Tata Chemicals operating profit of this year was 5 times higher than the interest it paid. So here we want the ratio to be as high as possible. This can also be considered as the number of years that this year's operating profit can pay future years' interest payments. So we can also say that Tata Chemicals can very easily pay next 5 years of interest payments with this year's of operating profit. Alternatively, we can say that the operating profit is 5 times higher than this year's interest cost or the finance cost. Godrej Industries' profit was just 2.93 times higher than its interest cost that it paid. So when the interest is high, automatically the profit goes down. Pidilite operating profit was 53 times higher than its interest of this year, or it can easily pay next 53 years interest cost using this year's operating profit. Aarti Industries has managed to keep above 4 years of coverage. Castrol India, since it didn't have any debt, it didn't have to pay any interest, hence no coverage or highest coverage it had. Next, we'll look at the debt to profit. This ratio helps us understand how much profit the company has earned this year and how far away the debt is compared to this year's profit, or what is the total company's borrowing, or what is the total borrowing of the company and how much profit it has earned. So we remove out a ratio, and this ratio will help us understand whether the company can pay its borrowings using this year's profit, and how many years will it take if we consider this year's profit as the base price and as the base value to calculate the complete clearance of its borrowings. Tata Chemicals' profit of this year can pay all its borrowings in next 5 years. That is, if the company keeps making the same amount of profit what it has done in the latest year, then that profit multiplied by 5 years can pay clear of all the debt. Or in other words, the debt of the borrowings of the company is 5 times higher than this year's profit. We want this value to be as low as possible, preferably 1 if it's possible, otherwise as low as possible. Godrej Industries, since it had a very high borrowing against its this year's profit, it will take it 16 years to pay off the debt. Or we can also say that the debt or the total borrowing was 16 times higher than this year's profit. Aarti Industries borrowings were 6 times more than its profit of this year. Pidilite and Castrol India's profit was enough to clear off. In fact, Castrol India didn't have any borrowings, so there is no question of any coverage. But Pidilite's borrowings were very minimal, and this year's profit can be used to clear off those borrowings. Next, we'll look at change in promoter holding over a period of 3 years, how the promoters have changed their shareholding in the company, whether they have increased it or whether they have reduced it. We'll look at the current promoter holdings of the company, and if the companies have made any pledge against their holdings. That is, whether have they given these shares as collateral or pledged their shares with financial institutions like banks. Tata Chemicals promoters have sold 0.31%, or their holdings have reduced by 0.31% from 3 years back, which is a mild drop. We generally would want to see a growth, like increase in holding by the promoters. Godrej Industries promoters have sold, or their shareholding has fallen by 13% from where it was 3 years back. Pidilite management or promoters have grown their holdings by 0.16%. Castrol India's promoters have sold off 20%, or their promoter holding has dropped by 20% from 3 years back. Let us look at the current promoter holding of these companies. Tata Chemicals promoters hold 30%, Godrej Industries 61%, Pidilite 69%, Aarti Industries promoters hold 49%, and Castrol India's promoters hold 51%. Most of these companies have a high promoter holding, so that basically assures us that the promoters have high stake in the company's well-being, and they will function, or they will make the company function in a profitable way. Let us look at the pledge. None of the companies have pledged any of their shares with banks or financial institutions. So to recap, the Tata Chemicals seems to be the biggest company of the group, and Castrol India had the lowest net worth. In terms of contingent liability, Castrol India had the lowest contingent liability, whereas Godrej Industry had the highest contingent liability against its net worth. Highest debt to equity ratio was of Godrej Industries, and its coverage was also the lowest at 2.93 years. Castrol India had no debt, therefore had the highest coverage as well as zero debt to profit ratio. Again, Godrej Industries had the highest borrowings against this year's profit. In terms of promoter holding, Tata Chemicals promoters were holding just 30%, which was lowest in the group. Pidilite Industries promoters had the highest stake in their business at 69%. None of the companies have pledged any of these shares. Next, let us look at the debtors to sales percentage, and then we'll look at debtor days, that is in how many days the company was collecting payment from its customers, and how was the payment cycle 3 years back. The debtors to sales measures the amount still to be collected from the debtors or from the customers against this year's sales. That is how much of the previous spending from the customers was still shown in the balance sheet against this year's sales. We don't want the debtors or the payment to be received from customers to exceed 30% of this year's sales. Most of the companies have done well to keep their debtors or accounts receivable below 20%. And how fast are they collecting from the customers? Most of these companies are collecting well below 90 days, which is our basic criteria for these companies. That is 3 months of maximum credit period. 3 years back, also we see most of them were managed to keep their collection days within 90. Tata Chemicals collection days 3 years back was 87 days, whereas today or in the recent year it is just 46 days. So the collection period has improved. Godrej Industries collection period has gone up to 40 days from 25. Pidilite's days have also gone up from 44 to 56. Only Tata Chemicals collection period has dropped from 87 to 46. This is what we want to look at when we are checking this particular ratio. Next, let us look at the company's inventory holding, that is the total inventory the company had in its business, and against that we use the sales as a comparison method to understand how many times over the inventory of the company was turned over into sales, or how far the company managed to convert its inventory into sales. Here we want the ratio to be as high as possible. Tata Chemicals sales was 7 times higher than its inventory holding of this year. Godrej Industries managed to convert just 2.2 times of its inventory holding. This could also signify that the company's current inventory holding is very high compared to its sales. Or we can also say it in another way, that the company has not managed to convert its inventory into sales. Pidilite has managed to convert 7 times its inventory holding into sales, and Castrol India had the highest turnover of 10 times. Let us look at how the inventory holding was 3 years back. Most of these companies had a very similar turnover of inventory into sales as they do it in the recent year. Next, let us look at the 5 years operating profit margin on average that the company has shown in its financial statements. The operating profit margin is the top line that we are interested in looking at to understand how the company has done its operations. We want this percentage to be above 15 at least, which shows that the company's management or efficiency in managing its expenses, operating expenses, is done well. So when the company sells its product, it generates revenue, and from those revenue we deduct all the expenses to get the OPM. All of these companies have managed a 15% and above OPM except Godrej Industry, whose OPM of 5 years on average is just 5.7%. So when the OPM falls below 15%, the NPM too would eventually fall, because from this operating profit we have to still deduct the depreciation expenses, taxes, interest cost, and if there is some extraordinary losses, then that too, or extraordinary items, that too will get deducted. So finally our net profit would fall below 10% if the OPM is not 15 or above 15%. All of these companies have managed a 10% and above growth rate in their net profit margin, except Godrej Industries and Aarti Industries, whose net profit margin has fallen below 10 times, or 10% for that matter. Here investors should look for at least a 10% net profit margin of the company. Let us look at the previous year's net profit margin. Tata Chemicals previous year was 23%, whereas the current year's NPM has fallen to 10%. So here we can see that the net profit margin has fallen at quite a high pace, or from 23 straight away to 10%. Godrej Industries NPM has increased marginally, but it's very low when compared to the other peer group companies. All other companies in the previous year had a good NPM of above 10%. We can also compare, as I said earlier, the previous year's NPM with this year's net profit margin and see how much the margin has fallen or increased. Next, let us look at the current ratio and the quick ratio. The current ratio is a liquidity ratio which measures the company's ability to pay short-term obligation, that is, to pay off its current liabilities using its current assets. So if the current liability of the company exceeds the current assets, then it will shows that the company is not in a very good position to clear off its liabilities. Generally, we would want to see as investors that the company holds enough current assets to pay off its current liabilities. Now, the current means those liabilities which have to be paid within this year, and current asset means those assets which can be sold off within this year. So here we understand how liquid the company is, or how well the company is managing its assets and liabilities, and if those liabilities do arise in this year, would the company be able to pay them off? We want the ratio to be at least 1 or above that. All of these companies have a ratio of above 1 times, that is, their current assets are more than their current liabilities, except Godrej Industries, which fell short by 85%, that is, its liabilities were more than its assets. In terms of quick ratio, this ratio too measures how well the company is able to pay its short-term obligations by selling liquid assets. Here in the current assets, we were using all, in current ratio we are using all current assets, whereas in quick ratio we use only liquid assets like cash or bank deposits and so on. Here too we want the ratio to be at least 1 or above that. Most of these companies have managed a ratio of 1 and above, except for Aarti Industries, whose quick ratio has fallen below 1 times, and Godrej Industries ratio is 0.5. That is, Godrej Industries assets are not enough to pay off its current liabilities. So to recap, we see for debtors to sales ratio, Castrol India are the lowest debtors compared to its sales, whereas Aarti Industries debtors, or money still to be collected, was 17% of this year's sales. In terms of collection period from the customers, Aarti Industries was taking the highest number of days of 63, and Castrol India was collecting at the fastest rate of 36 days. In terms of turning over inventory, Castrol India has turned over its inventory 10 times more, and Godrej Industries inventory turnover was the lowest at just 2.2 times into sales. 5 years OPM again was lowest for Godrej Industries at just 5%. NPM 2 was the lowest at 4.5%. The highest OPM as well as NPM was seen in Castrol India at 26% and 18%. In terms of quick ratio and current ratio, Pidilite had the highest assets to liabilities, and even in quick it had the highest liquid assets to cover the current liabilities. Godrej Industries assets were not enough, or current assets were not enough to clear off its current liabilities. Next, we will look at the depreciation that was charged on the assets and the accumulated total assets that the company owns up till now, and the accumulated depreciation that has been getting deducted every year, and what is the total net block or net assets available with the company in the recent year, and what is the depreciation rate charged on the net block. So basically we are going to compare the total assets and see how much of the total assets there is accumulated depreciation, and then on the net block what is the depreciation rate charged. So this helps us understand how the companies are stacking up against each other in terms of depreciating their assets over a period of time. Gross block is the sum total of all assets of the company valued at their cost of acquisition. Accumulated depreciation is the cumulative depreciation of an asset up to a certain point in its life. Net block is what the assets are actually worth to the company. The net block is calculated by deducting accumulated depreciation from the gross block. And finally, the depreciation is an accounting method of allocating the cost of a tangible asset over its useful life. This is how the assets are depreciated over a period of time from balance sheet to P&L account. First, we'll look at what is the accumulated depreciation percentage of the total gross block. The total assets of the companies were, for Tata Chemicals, 15,000 CR was invested in the total assets of the company, on which total depreciation accumulated up till now was 2,000 CR. So that works out to around 13%. The company still has to pay off or clear off this total gross block by deducting annual depreciation from these assets. Godrej Industries had 3,700 invested in its total assets, and on that the total depreciation accumulated till now is 440 CR, and its current net assets after depreciation is 3,800 CR, and it is charging 175 CR on its net block. So we have the depreciation of how fast or how slow the company is depreciating its assets. The depreciation is a non-cash expenditure, and it directly affects how much profit the company is showing in its P&L account. So the faster the depreciation rate, the lower is the profit that the company has. Pidilite's assets, total assets were 2,340 CR. This also shows how much the company is investing in its assets and what is the rate of depreciation that is being charged on those assets. Aarti Industries assets were 2,800 CR. The lowest assets we see was for Castrol India. This company had an assets of total 307 CR. And on that 120 CR of depreciation has already got accumulated. Now the company has only 186 CR of net block or net assets. So the bigger the company, the more assets it will have. So we can see that the highest depreciation accumulated was for Pidilite on its total assets of 42%. That is, now only 42%, balance of 42% is left over as net block. In terms of depreciation rate charged on the net block, or every year, how or by what percentage are the assets getting depreciated, we see Castrol India is depreciating the assets at a very high 30% rate. Rest all of the companies are in a comparable range from 4 to 9%. In terms of dividend yield, the highest dividend was provided by Castrol at 3.77%. Dividend yield is as per the last year's annual dividend percentage, and it is compared with the current price. Dividend yield is an extra bonus which a shareholder can expect to receive for the risk he takes in investing in the companies. This concludes our analysis of the companies which are in chemical sector. We see that Castrol India has got the highest marking of 112. Before that, let me put in all the scores for the rest of the ratios, then we'll come back to the final scoring. So to finally recap, Tata Chemicals had the highest asset and Castrol India had the lowest asset because it was the lowest net worth company in the group. In terms of measuring how much of the gross block was already depreciated, we see Pidilite had the highest accumulated depreciation of 42% of the gross block, meaning in the future years its depreciation will be only on the rest of it, and in the future years the profit may grow faster if the depreciation on the assets falls. Godrej Industries had the lowest accumulated depreciation on its assets, that is only 11%, so balance assets are still to be depreciated over a period of years. So here, in terms of accumulated depreciation, higher the percentage the better it is, because we already know that most of the assets have already been depreciated and rest of the assets would be depreciated over a period of time, but it won't reduce the profit at that rate. In terms of recent depreciation rate charged on the net block or net assets of the company, we see Castrol India's depreciation rate of the current year was very high at 29%. We don't want to see such high rate of depreciation because that reduces the profit in a big way. Pidilite's depreciation rate was the highest in the group. We want a high depreciation rate, but we don't want it to be very high. Around 15% to 20% is all right for assets to be depreciated at. Looking at the dividend yield, Castrol India paid the highest dividend yield of 3% on the share price, and Aarti Industries' dividend yield was the lowest, next to negligible on the share price. So now finally this concludes our analysis of the group companies. We see the highest ranking company was Castrol India at 121 points, followed by Pidilite at 111 points. Tata Chemicals had 97 points and Aarti Industries had 99 points. So these four companies, Godrej Industries scored the lowest at 72 points. So let us recap the good points and the bad points for each companies, starting with the companies which have scored the highest points. Castrol India scored 121 points. Let us look at the score that it has received and in which particular score it has got the best. In terms of return ratios, ROE of the average of 5 years, it has been earning highest return on the shareholders' money. Even latest year it was 64%, which is very good. In terms of return on capital employed too, it was the highest both for 5 years on average as well as the last year. In fact, in the last year it has earned almost 100% on whatever capital it has employed into the business. Return on assets was the highest turnover of assets into sales of 3.3 times more than the assets. Return on invested capital was the highest of 102%. So the company has done very well in returning, that is earning profit on shareholders' money as well as borrowed money on assets also. But in terms of valuation, if you look at the recent 12 months, we see it has become very reasonable at 18 times, and price to OCF wise also it has fallen below 25 times. Price to free cash flow is above 25 times at 28, and price to book is very expensive at 12 times. So this company is trading at a very high premium valuation. If you look at Pidilite also, it had a very high price to book value of 14 times. We do not want to, even if the company has a very good score of 121 points, 111 points, we cannot invest at such high price to book value. We want it to come below at least 2.5. Although it looks difficult for these companies to come to that valuation, because they are earning very good returns on the capital employed and on equity. The company's free cash flow was short by just 7%, the best in the group of 5 years. That is, whatever cash the company has earned, it has invested the lowest in buying of fixed assets. Its fixed assets are the lowest in the group, or investment in fixed assets is the lowest for in last 5 years by the company. So this is another good point for the company. In last year, its cash was short by 22% of its profit. That is, whatever profit it earned, that is 708 CR, only 549 came in as cash. It was fallen short by 22%, the highest in the group. Here we want the CFO to be at least equal to or above its profit after tax. In terms of quarterly sales growth rate, it was the lowest. That is, year on year, its sales have grown at the lowest rate of 5% in the peer group. In terms of profit, from the previous quarter, the profits have fallen at the rate of 12%, and the sales too have fallen at the rate of 5.5%. So in the recent quarter, it is not doing very well. It's the lowest net worth company, a very small cap company of only 1100 CR. Its contingent liability is the lowest. It is a zero debt company. That is it does no borrowings and no interest cost associated with it. It has the best debt to profit, that is 0 times, since there is no borrowings. In terms of debtors to sales, that is the lowest debtors. There are no accounts receivables or minimum accounts receivable of 9% against this year's sales. It is collecting payment from the debtors at a very fast rate of 36 days. It has also turned over its inventory at the fastest multiple of 10 times. That is, inventory is getting converted into sales 10 times higher than its inventory holding. Its OPM of 5 years on average is the highest. The NPM is also the highest of last year at 18%. We see that the company's total assets was the lowest in the group company, although that's not a negative because it's a small cap company. But since we're comparing the peer group, it had the lowest assets of all companies. Its depreciation rate that it charges on the net block last year was very high at 30%, and it was paying the highest dividend yield. So here what I see is, although this company is very good fundamentally, its price to book value or valuation wise, it is not the correct time to invest in this company. If the ratio falls below say 5 times, I would say if the all the other fundamental ratios are intact, the return ratios are intact, and the price to book falls below 5 times also, then that too would be reasonable. But as of now, I would not suggest investing in this company at such high valuations. Next, let us look at Pidilite. Its earning yields was the lowest. That means the price was very high and the earnings per share was very low. Its recent price earning was very high at 67 times. I would definitely not recommend anyone to invest at such high valuations. On average, last 5 years PE was also very high at 47 times. Its price to cash is very high. Even if price to earnings was high and price to cash was low, I would still consider it for a buy. But here, in terms of cash also, the company's price is way too high. Free cash flow is also very high. Price to book is high. Price to sales is very high. That is, its total market cap was 8 times higher than what it sold last year. So at these high valuations, it's a no-no even if the company has a very good fundamentals. We don't want to buy very high by paying a very high valuation or very high price. Its profit has grown at the highest rate of all the group companies in the last 3 years. It had a negative drop in its sales from its previous quarter. Promoter holding was the highest of the group companies. Its current ratio and quick ratio were the highest. And it's the way it is depreciating its assets, or the total accumulated depreciation on the total assets was the highest. Its depreciation rate was also highest in the group companies at 8% on the net block. As I said earlier, both these companies, Pidilite and Castrol, have very high valuations, which doesn't allow us to invest in these companies. If we see, Pidilite has just fallen 6% and Castrol has fallen 23% from its 52 weeks high. Next, let us look at Tata Chemicals and Aarti Industries as well. Aarti Industries has fallen the least at 6%. Its profit in the last 5 years has grown at the highest pace. Its PGs are very good at 1.6 and 1.5 times, the best price earning multiple we can pay and get the highest profit growth rate as well. Sales for both 5 and 3 years was the highest in Aarti Industries. Sales is a very important metric to look at because this is the starting point from which the revenues are generated and eventually translates into net profit for the company. Although the company was earning at the highest sales, in terms of returning or in terms of return on equity, it was the lowest at 0.26. We don't want to see a ROE of less than 15%. Excuse me, this is the ROE growth rate. So ROE growth rate was the highest for Aarti Industries. Its ROEs were also very high at 23 and 22. Aarti Industries' debtors were the highest compared to its sales, and it was also taking very high number of days to collect payment from the customers of 63 days. Although it is below 90, but in terms of peer group, it's taking a very high number of days to collect payment from the customers. And it was providing the lowest dividend yield as well. Finally, let us analyze Tata Chemical as a standalone company. It was down 17%. Its earning yield was the highest at 7%. So the price and the earning justified the multiple that we are paying. When the earning yield becomes the highest, its price earning will also become the best. So it is available at just 14 times, the best in the group, the lowest price that we can pay for the earnings that the company is giving. Its 5 years historical price earning was also best. So it was trading at just 13 times over a 5 years average. Its price to book value and price to sales was the best. That is, its price market cap was as good as its net worth, or was very near to its net worth. In terms of market cap against the sales, the market cap was just 1.45 times higher than its sales, and it's the best of the peer group. Sales have fallen for this company for both 5 years and from 3 years back as well. The rates were 6% drop in 5 years and 8% drop in last 3 years. We don't want to see a negative value in terms of sales. The sales should always be growing, which shows the demand for the company's product is intact. Tata Chemicals assets were turned over at the lowest pace. In fact, its sales was just 61% of its assets. So whatever assets the company has employed into the business, that has not been able to generate a high sales. It had the highest conversion of profit into cash of 86% above its profit. But when we look at the recent 12 months earnings, we see it has fallen below its average profit by 14%, the highest drop in the peer group. Its profit from the previous year has fallen by 59%, which is again not a very good sign. It's the largest group company in terms of net worth of 12,341 crore. Promoter holding is the lowest at 30%, although this should be a negative. It has the highest assets, fixed assets of the group companies at 15,600 crore. This concludes our analysis of these companies. Thank you for watching this video.